at a higher level, let's start from the higher level and then we will drill down. So at the highest level, if you see, whether you are an individual or you're a company, you have savings, and the savings that you have, you would need to invest. And that is where people choose to invest these savings into different assets. And those assets could be real estate, buying a house, buying an office, or it could be, buying bullion like gold or silver, or it could be putting money into fixed deposits or savings deposits, or it could be investing in equity. So now a lot of people do this themselves. However, there are times when you do not want to do it yourself, largely because you do not have the time. So you have savings, but you have a job, you have your life, which is not really focused on investment management. So what you do is you look for professional fund managers who do this investing work for you. Where I come in, I specialize in managing the equity piece. So there are funds that specialize in investing in real estate. There are funds that invest in commodities. There are funds that invest in currencies. There are funds that invest in equity. And now in equity, when I say, if you break down the equity piece further, it breaks into long only funds that only invest. And then there are trading funds that do long short, that they can buy and sell short at the same time. Those are the hedge funds. And then there are private equity funds that invest in private companies that are not listed. So this is the general breakup of equity fund management. Again, to recap, you have a fund which invests in listed stocks on the exchange, NSE, BSE. And then you have a fund that invests in these stocks, but can also do derivative trades. So they have a hedge fund strategy where they are long and short at the same time. And then you have private equity funds that invest in companies that are not yet listed. So this is now, as a fund manager, my job is to make sure that the investors who have invested in my fund, and what they have invested in my fund is the savings that they have. And the savings can come in from multiple sources. It can come in from their inheritance. It can come in from professional success. They have done very well professionally. Some of them are very successful business people who continuously take out some of the money and invest, because all of them know that there is a limited period of time that they can work. Beyond a time when they retire, they want that corpus that they have saved over the years of their working life is large enough that they can retire sensibly. So, and retire in a comfortable manner. That's the whole objective. So that is where fund managers like us come in and say, look, we will pool in capital from multiple such people. We will pool in capital not only from individuals, but even companies. Companies have surplus capital, like Reliance has 150,000 crore of surplus capital at any point of time that it invests. So they are also, managers like us come in to help create portfolios of very good companies that generate long-term returns for these investors. And we do it in a very structured and formal manner. Now, the long-only funds also are of different types. As you said, Nikar, there are the mutual funds, most common. Everyone here will be very familiar with what a mutual fund is. Mutual fund, as the name suggests, people come together in a mutual manner and say, okay, here, like HDFC mutual fund, large cap fund, here is, my money, please invest it I'm investing in the fund, and the fund will take that money, invest in the portfolio. And that fund will have a fund management team. It will have not only one person, but one person supported by 3-4 research people, supported by analysts, and there is an operations team behind it, and there is, it's a big team. So that is what fund management is. It is basically, in a very simple way, equity fund management is taking savings from individuals and companies and investing for long-term wealth creation, so that when people need that money, they have plenty of it, so they can retire in a sensible manner. That is what I would say is fund management to us. think that's very fair understanding, and I'm glad you brought in or you touched upon the subject of risk also, here, because as a fund manager, you're not only looking at returns, you're also looking at the risk, because each asset class has its own risk and return. So equity generates higher return for you compared to a fixed deposit because it's also more risky, it is more volatile. So as a fund manager, when you're doing your research, you're constantly analyzing risk, and which is something that individual investors are not able to do. And I think that's where professional fund managers come into play, because they have a better understanding of risk that come, a company specific risk, and then there's a market risk, so how these risks come together, and how, whether the risk return is favorable is most of the time is what the fund manager is analyzing, and you look at ideal opportunity to invest is when you can find an opportunity that is low risk but high return. And as a good fund manager, that is all you're endeavoring to do through your research, that you can identify something which can give you very high returns but has very low risk. Now, because the markets are efficient, it is difficult to find such opportunities, but that's the holy grail. And you try to be as close to that zone as possible, so that, you build a track record over a period of time, and then the investors look at your track record and say, yes, this is a good fund manager, because on a risk adjusted basis, this fund manager is doing better than other fund managers, so let us give them the money. So I think that is what, if I was to complete that discussion, I would add to that.